The April MPC was a bit hawkish. The Reserve Bank of India has set the ball rolling for policy normalization by signaling gradual withdrawal of the loose monetary policy. The priority has changed from supporting economic growth to containing inflation. We expect the first hike in the second quarter of financial year. The RBI has also cut the GDP growth forecast to 7.2 from 7.8 in February and raised the average inflation forecast to 5.7 from 4.5. As far as bond market is concerned, this marks the end of the rate cut cycle and the beginning of the rate hiking cycle. We should expect higher bond yields and steeper yield curve going forward. India's macroeconomic landscape has been colored by the ongoing conflict in Europe and sudden increase in crude oil and commodity prices. This has disrupted the inflation outlook and worsened the current account deficit. Higher energy prices will also impact discretionary consumption and negatively impact economic growth. There has been net outflow from foreign portfolio investors this year as Federal Reserve's monetary policy has been super hawkish. All these mean the RBI will have to turn neutral and start hiking policy rate as soon as second quarter of this financial year. We expect government bond yield curve to turn steeper for some more time. Short end of the yield curve will remain anchored due to surplus liquidity environment, while long end will probably harden a bit more due to increase in fresh supply and subdued demand from the rest of the investors. Yields of the benchmark 10-year government bond has crossed 7% for the first time since May 2019. With the commencement of the new borrowing cycle, we should expect some more hardening of yields in the near term. It's tough to be the bond investor when the Reserve Bank of India is set to change the course. We expect low single-digit returns from the bond market this year as well, like last year. That said, rising bond yields will also provide investors with an excellent opportunity to lock in higher yields for their long-term asset allocation through investments in target maturity bond ETF and bond index funds in our view. We prefer high-quality bond ETFs and bond index funds maturing in 2026 onwards, as there is value at the long end of the yield curve for investors with investment horizon of at least 3 years. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.